Welcome to this year's CEO presentation for the pre-season meetings for 2021. This form of presentation is probably a little more detailed than what we do when we're out at the shed meetings, and it's a good opportunity to actually get members up to date with what's happening in the business. So the program we're going to go through with this presentation is to firstly look at our business continuity plans, and of course with COVID, it's mainly addressing the COVID issues, and it's important that we don't fall off in the way that we actually approach that side of the risks of a business. I want to have a look at the season summary for 2021, what our projections are, have a look out to the next season for 21-22, and there's some very positive news out there in the sugar market at the moment. Have a look at it in a bit more detail, the sugar market. There's a few different things in there that probably are worth talking about. Our diversification programs, and there's been some good advances in that side of it this year. Look at the strategic plan, and then have a look at the overall industry and any issues that are occurring there. Again, I think we need to understand, and I think we all do, that the sugar industry is under pretty severe pressure here in Australia. These increased sugar prices might assist, but typically if we don't do something different, we're going to have problems. So when we consider our business continuity plans, we need to acknowledge that the risks that are associated with COVID-19 have not gone away. It's very clear when you look around the industry and the Australian economy that there are risks all the time, and we've had some recent examples locally, which I'll talk about at the moment. But it's important that we maintain our current programs, and as I say, stay the distance on them. And the key focus in some of that is the hygiene and sanitation programs we've got in place are very important. We need to maintain them. We do that as a part of our normal operations now, but at the end of the day, if we maintain the hygiene, then we've got a lot of the risk covered. Social distancing is important. We need to continue to promote that, and I know that in some cases it seems a bit overboard, but at the end of the day, if it's going to save the business and the employees and our members risks, then we should be doing them. Our programs are all set around not travelling if we can help it, and not meeting face to face with people unless it's absolutely necessary. And so you'll see us doing a lot more virtual meetings, board meetings held virtually, all of our research meetings held virtually, and in this case the pre-season meetings being held virtually. I know again that it's not the best way in some respects to communicate, but in other respects it is good. So we need to keep those virtual meetings going. You only got to look at the Byron example most recently to see the impacts that it can happen. We had one person who was in the pub at Byron when that person who was infected was there. That meant they had to be isolated out for 14 days, go and get tested, but that also meant that we couldn't run one of the shifts at the packing plant. And so there we are, one simple example. It wasn't a big issue, but anything that can get bigger, like this can with the COVID, with shutdowns and things, could impact on the business. So again, it's critical from a crushing perspective that we will buffer. So that's the intent to start in June, and I know I keep saying that from a milling perspective, these plants are not going to deliver great availability. They simply can't. They're old, and we don't spend a lot of money on them. So that's the first important part about having a June start dates. But the second important part is if we do get an infection, if we do end up with a situation where we have to shut plants down because we don't have people available because they're in isolation, then we will start to see some significant impacts in the business. So it's important that we keep our business continuity plans updated and that we're in front of the risks. Let's have a look at what our projections are for the 2021 season. the one that we've just completed, and maintenance programs in place at the moment. What we did do is crush about 1.7 million tonnes of cane, made a little over 200,000 tonnes of sugar, and our pricing is somewhere around 451, 452, with a cane price of around $432. We did see some good savings during the year, particularly through our transport operations, and obviously this year with the new quads in place for most of the season, then I'm expecting that we'll save further costs there. We've got some sales of some of the old trucks and trailers, which will put some more money into the business. We did spend more than $2 million than we'd spent the previous years on our maintenance programs, and some of that was in the boilers, but overall there was an increase across the business from a maintenance perspective, which was important. We have been spending less over the last few years in our maintenance, and being able to actually put funds in there may assist with our availability over the next few years. And it's hopeful that with these increased prices that we'll be able to increase that program a little more in this next 12 months coming up. Of course, we've got to remember in that $1 million loss, we also received $2.5 million through JobKeeper. So without it, obviously we would have had a significant loss in the business. I know people sort of question how we got JobKeeper, but we have had it audited. And at the end of the day, we met all the criteria that were required, and significantly, it was funds that we were able to put back into maintenance and retain employees in the business. So at the end of the day, it more than just met the criteria; it actually met all the targets that they were after. So that was important. The refinery operations are expected to deliver above $2 million profit for the year, with projected sales of about 210,000 and possibly a little bit more. We did get in 15,000 tonnes from Rocky Point. There were some issues during the year that did cost us some money. The refinery suffered, losses of $600,000 to $700,000 with the shortage of supply we ran into when we had the major shutdown. So we were out for a bit over 3 weeks, and we had to import some finished product out of Bundy and Wilmar over that shutdown period to be able to service our customers. And it did cost us money, and it did cost us a bit of reputation, because at the end of the day, when you don't service the customers at the levels that they're normally used to, then you're starting to put yourself at risk from forward sales programs. During the year, we sold the Clyde warehouse to Manildra. That was part of a rationalisation process that we're going through. We're expecting savings of around $500,000 to $600,000, possibly up to $800,000 in our operational costs as a result of the change. Manildra will provide us with third-party services as a service into Sydney, and we've got that negotiated, and as I say, that compared to what we were paying before is going to save us a fair bit of money. As I said, the refinery is expected still to deliver above $2 million in profit for the year. And when you add that to the $1 million loss out of the mills, then there's a fair expectation that we're going to deliver about $1 million profit in the overall business for the year. From a cane payments perspective, things haven't really changed since the circulars I've been sending out 3 or 4 months ago. At the end of the day, we're still expecting a cane payment sugar price of around $432 for cane. That'll mean Condong will get $31.41, Broadwater $33.26, and Harwood about $32.27. Now that compares reasonably well with our benchmarks that we set against QSL. We're slightly ahead. We're not as far ahead as we have been in other years, but at the end of the day, it's still probably a pretty positive outcome. If we step forward now to the next season and have a look at the future sugar prices in particular, and look at our profit and loss and our operational changes that we're making, I think there's some good outcomes that we've got coming, and I think growers will be very supportive of the prices that we're talking about and the programs that we've got in place. The 2021-22 season looks to be pretty positive from both a crop and price point of view. The crops that we're projecting at this point, and it's always difficult at this time of year to get it right, but within reason, Harwood's looking at 680 to 700,000 tonnes, Broadwater 700 to 750, and Condong 450 to 480. So that gives us a total of something like 1.9 million tonnes of cane, which is well up on the last few years. Nowhere near where we have been, but still well up considering what the crops have been through. Total sugar mate around 205 to 215,000 tonnes. Our sugar price, we're looking at 480 to 510 again. That's a pretty dramatic jump there. When you look at the programs that we're going to put in place for the year, I expect the mill maintenance program will be similar to last season, with less spent on the boiler down at Harwood and more in milling operation or plant rather than the refinery. Insurance is still a major cost and a risk issue that we've got to deal with. It's not going to get any less, and at the end of the day, it's important that we recognise that as a part of our budgeting processes. The new transport system will be in place, and as I said previously, I'm hoping that we can deliver at least another $1 million in savings for the year. So overall, even despite all those positive news, I think we can break even and maybe do a little bit better. Hopefully, a little bit better is the outcome. We've set a target of 230,000 tonnes of sales for the refinery in this next season. And as I said before, that's not going to be easy to get, but we've certainly got some good discussions going on with some of the bigger customers, and a move away into some of the bigger bulk customers will be a good thing for our business. We've lost a bit of credibility out there with customers. Shutdowns, the floods, machinery issues, COVID has certainly impacted out there, and we need to perform to be able to maintain our credibility out there in the marketplace. We're expecting that in the sales program that we're going to be able to deliver between 150 and 300 points. We're doing a lot of the little sales now between 250 and 300 points, and the big guys 150 to 170. So remembering that 100 points is somewhere around $30 a tonne, then that's important as a part of our sales program. We are running right at the moment as a 7-day continuous operation. If we can get the sales program in place that we want, then they can be maintained, and that's the best way to operate anyway. Keeps the plant running properly and less shutdowns, less maintenance issues. The big issue still for the refineries is fuel. A lot of different issues there that are impacting from that perspective, and Dave Woods will talk a bit more about that in his report. Projected refinery profit somewhere around $2.5 to $3 million, and maybe a bit more, with an overall business profit. Then if we can get the mill to break even or better, then we could be up around the $3 million profit for the year, which is a good outcome for us. Looking to the sugar price and the advance rate for 21-22, there is some good news. And I've been able to say this for a few years, but at this point we've got about 45,000 tonnes of physical sales in place at around 490. We've got hedges at 45,000 tonnes at around 541, and that includes pollen premium. Then the futures prices, and they just jumped again overnight as I'm recording this, so there's no doubt that they'll be at 510 or better. So that gives us an overall price of around $500, and I'm thinking it could be higher. Mind you, if this market decides to turn on its tail and go the other way, then the world will change. And that gives us a cane price of 490, and that's a pretty good price compared to many of the other years. Our hedging program at the moment is to keep going. So if the way the prices are at 45,000 tonnes priced at this point under the hedges, and this market continuing to go up, we'll just continue to actually put sales in place hedged at something better than those prices. So always believe in following the market up if you can, and at this point, if that market continues to rise, that'd be nice, and we'll just continue to sell into that market. It's the old story again. You've got to be satisfied with what you're targeting, and at this point, believing that $500 or better is a good price for both the business and the growers, then we'll hedge into that. If we get it wrong and the price flies through the roof and goes up to $30, another $30 or $40 or $50, and you're talking $550 or $600, so be it. We will be pricing into there anyway, but not at the end of the day. We'll have done some at a lower price, but certainly at prices that we're comfortable with. We've been able to maintain some good premiums in the marketplace, and as I said before, so if we can add that to these sort of prices, then it's all looking very positive. We've got a proposal at the board at the moment, right as I speak, which sets the advance rate at $260, and that's $40 up on last year, with effectively $19.50 or better, depending on which mill you're at, per tonne of cane being paid. So that's all again quite positive, and our intent is to make sure we can deliver at least $500 a tonne at this point. I've put together a little scale here, schedule of comparisons of what sugar price would be versus CCS in this current market. Now, I've highlighted 490 to 500, and I'm pretty confident that's where we're going to be. Typically, if you take a $500 sugar price at the different CCSs, 11.8, 12, 12.2, 12.4, talking between $37 and $39. So I'm fairly confident we're going to be up around at least 38 if we keep this program in place and the market stays up where it is. So again, good news there. Just looking at the sugar market, and I'll go into a bit more detail here in the next couple of slides, but specific to our sales program, we're looking to continue with the increase in the premiums based on the back of the Southeast Asia premiums. At the end of the day, the Thai crops, while they're expected to improve next season, are not much better this season well. In fact, they're less the way the market's talking than they were last year. So there's every opportunity for us, I believe, for us to be pricing some additional premiums into our sales programs. Thais are selling between 180 and 250 points. There is a major shortage in that market. We have seen tenders out there for Thais with Myanmar paying anything between 210 and 280. QSL are certainly achieving around 200 points or better in their sales programs. And just remember, 100 points is approximately $30 to $35. So, that's a key part of our program going forward, a key part of what we can deliver as part of the sugar price and the cane price. Just looking past the current market, so if you look at the slide here, the ICE 11 at the moment, if you look through July through to about May, we're talking 450 to 475 without any premiums in them. But then if you look past that, then this curve is inverted. In other words, go out to say May 23 and you're only looking at 420. This market as out in the futures doesn't look great. But that's an interesting situation. So are we going to see the longer term futures curve actually move back up? Because if you remember, not that long ago, it was actually the other way around. Mind you, we weren't seeing 475, 500 in the forwards, but it was certainly a different curve to what it is there now. There's an expectation that there'll be a sugar, supply will increase in that period versus the tightness that's there at the moment. That it doesn't necessarily ring true. my view is that we're actually going to see those backing prices start to move back up. They might not get to 500, but I believe there'll be strong 400 prices out there in that forward curve. But it is something we need to be careful of, and we need to actually manage those prices out there. And there's a few different things we're considering that could give us some better outcomes out there. So just remember that we've got a good 12 months here. And it's the same old story with sugar. It goes up, it goes down. But let's be positive. We've got a great 12 months coming at us, and hopefully this curve will move back up the other way. I want to look at our diversification programs, and part of our strategic plan. This is a key. As I keep saying, at the end of the day, we've got to be a bit different, and just relying on the sugar prices isn't going to deliver us what we want. So diversification is a key part of the platform that we've got as part of our plan. Our first project is the botanical water, and it's been coming and going a little bit in this last 12 months. But right at this point, we're expecting to have a brand new plant up at the Condong before the start of crushing. Aqua Botanical have paid process partners to redesign a new plant, and it'll produce a completed product. In other words, it's fully potable water. You can drink it straight out of the tap off the plant, and that's important for us for a number of issues. I'm expecting that it'll be installed before July, and that we can actually send the product to our bottlers, but also send it to other customers. So if there are customers out there that want to have this type of water, and it's got a great environmental story behind it, then we can send it to them without actually sending it to bottlers. So I think that's an important part of having a completed product there on site. We're still looking at around 11 million litres for 2021. Aqua Botanical saying that they believe they've got customers from a bottled perspective, but are happy for us to go out and venture into other customers if we can find them. And for that purpose, Manilda appointed a specialist salesperson to market all of our specialist products, but also their own, which they've got now. They've got some other new products that they're getting into. So that's going to be a key part, I think, of delivering the outcomes that we're looking for. The next project that's about to kick off is the Sustenance project. This has been a demonstration of how, if you get the right people in research, to look at all the different products that they can make as part of the research they're doing, how this project actually demonstrates a great outcome from that perspective. And we've got to give Sustenance their due praise for the approach that they've taken. So the first part of this project to kick off stage one will be a gourmet mushroom grow bag project. Sounds a bit different to talking about, enhanced sugarcane straw feedstock, but that's, as I say, is a part of what a good research group can do for you. So as part of the process, we can actually create these mushroom grow bags. We've identified a market for it, which was important. We're going to spend about $1.7 million with a 3 to 4 year payback. We're going to utilise bagasse initially and then go into trash. When you actually look at the product, it's again a great environmental outcome where we're effectively creating a food for the economy, and it's coming out of our trash, in this case some bagasse at the start with. So, and that's the first stage of the project. Stages 2 and 3 will be much bigger, and we'll go down the path that they were originally designed for, to create feedstock for the cattle and horse markets, equine markets. So we're pretty pleased that we're able to get this one up and running, and with a 3 to 4 year payback, meets the criteria required for our business plans. The banks have all approved it already, so Rabo's quite happy with the whole process, and the loans are in place to actually get that plant up and running. That's at Harwood. I don't want to spend much time on the other projects that we're looking at, but certainly the cane juice project is now back on the radar. We're doing a business case for that. The people that developed this process have done it with CSIRO. And the key in any cane juice is about shelf life, and it's very critical. And they've come up with a process that can actually deliver great shelf life. And so going forward, that project is probably about 6 months away from an approval process. It's going to produce juice, it'll produce food grade fibre and a high grade liquor, which again will be a key. It'll be a very clean high grade liquor. It'll be a keen part of, a lot of the distilleries are looking for this type of product. So I'm thinking this is going to be very positive, this one. We've also had an approach from some researchers and investors who are looking at vegetable protein. So we convert liquor or molasses or sugar to a vegetable protein. And again, if we've got the cane juice factory actually running, the high grade liquor that comes out of that will be great feedstock for the vegetable protein manufacturing. And the rum distillery, whilst it's gone into abeyance for a little while, has been kicked off again. We have a number of proposals before us to actually look at putting a rum distillery at one of our sites. Not the easiest projects in the world, because at the end of the day, there is limited cash flows out of distilleries if you stick with brown rum, but there are other ways of doing it, and so I'm expecting that that could get up, but at this point in time we're just going through the normal processes and putting both business cases together. But this overall mix of products that we're talking about, so if we can produce aqua botanical or bottled water or water from cane that could be used in a rum distillery, then you have a real synergy there, and that actually is the case all the way through with all of those three projects. So, there's some great synergies in the projects that we're looking at, which could deliver some great outcomes for us. From a strategic business plan point of view, I think it's important that we look at some of the new things that we've added into the plan. First thing is that we've summarised everything in the plan down to a plan on a page, and I've asked Vivian if she can put that up onto the website so members can have a look at that. The biggest project that has changed in the plan is about our loss of cane land. So if you look at Broadwater in particular, over the last 2 years, we've lost over 3,000 hectares of cane land here, gone to macadamias, cattle, pecans, a whole range of different other commodities and agricultural pursuits. So whilst we've lost the 3,000 hectares, we're still looking at over 700,000 tonnes of cane at Broadwater, and so at the end of the day, that's not something that is going to cause us any major issues if we can stick around at 700,000 tonnes. But you have to recognise that this isn't just going to go away. Whilst the sugar prices are surging and macadamia prices are actually going down, there will still be pressure there. There's no doubt about that. So we need to recognise that. You can't just say ignore it. So we've got a team looking at what we would do from a rationalisation perspective, and that doesn't necessarily mean shutting a mill down, but what it does is make sure that you focus on reducing your fixed costs for starters, and then looking at opportunities on how you utilise the assets that you've got. As I said, you simply can't sit there and say, hey, so what, we've lost some cane land. We've got to be able to have a plan in place if things the crop continues to drop away. I think it's critical that we make sure that we get the Rocky Point cane if that opportunity comes up, and that can mean effectively cane coming from Upper Rocky Point to Condong, and then cane possibly transferring down from Condong to Broadwater. There's a whole lot of opportunities in that, particularly with the new transport options that we've got in place. So we'll be looking to and we already have had discussions with Rocky Point about the future. And at this point, whilst it's about putting sugar from up there through our business, it could well be also putting cane through the business as well. And part of any part of the business, and I keep saying this, is that you must have an underlying, strategic position as far as the culture and the way the business operates. And so there is a focus this year in our planning on the workplace culture and continuous improvement programs. We've re-established the engagement team so that they focus on that area. And as I say, it's a key part of any business going forward. Stepping outside of the business and looking at the industry situation in Australia, there's no doubt that we're under pressure, and these sugar prices, as I said, might make a difference for this next year or so. At the end of the day, it'll still come back in that cycle, and so you only got to look at what's actually happening in the Wide Bay area. Is a very good example. Maryborough Mill is shut down. That's it, no more. Won't be crushing this season. Midpole have got a 2-year contract with the growers there on a supply contract, so they've negotiated for the cane to be transferred from Maryborough up to ISIS at effectively Midpole cost. But that's 2 years, so there's 2 years of support there from Midpole to actually subsidise the transport arrangements there. But after 2 years, that's the end of it. So obviously, ISIS are going to have to step up to the plate, and that's going to be interesting to see how they can manage that. ISIS are going to build a translator and a spur line close to Childers industrial area up there. The government are assisting, 2.5 odd million from both of them to get that up. Translators aren't the greatest things in the world. Effectively, you're taking a road transport system, taking bins off, tipping them into a translator, which is effectively a set of bins to actually on the line. And then you have a spur line, you move the bins around. It's not the most efficient thing that you'll ever see, and generally you'll have problems with it from a logistical point of view and scheduling point of view. But it's probably the best way they could have done it at the end of the day. So you can see there, just in that one situation, that there are additional costs being incurred, and whilst it might support ISIS for a period of time, that's for sure. At the end of the day, it's a rationalisation that's had to happen for them up there. Bundaberg have actually shut down Bingeroo Mill, and so that only leaves them with Milliquin. They're not expecting to do much more than 1 million tonnes of cane this year. In fact, they're talking about less. And they're seeing a lot of land up there to other commodities. In fact, Bundaberg have stepped in as one of the biggest investors into other commodities, not just macadamias, but other plants and things like that. At the end of the day, it's certainly not being seen as a totally supportive sugar industry up there. So who would have thought, if you go back 10 or 20 years ago, that you would see Bundaberg down to 1 mil and Maryborough shut? It's just it just shows you the situation that the industry's in. And thank you for taking the time to watch this recording. Hopefully it's given you information that you're looking for. Don't be afraid to ask any of our guys if you're looking for additional information. I was going to ask Vivian to set up a Q&A again. Didn't get a lot of response last year on that side of it, but no need not to do it again. So we'll set up a Q&A situation where you can send in your questions and we'll answer them from there. So I hope you have a good season. I hope what I've put in front of you is some positive news, which I think it is. And let's look to the future. Thank you.